Hey guys, welcome to Learning Accounting. I'm Jim Abdulkabir, the founder of Learning Accounting, and this particular channel is expected to treat all related accounting issues, especially for professional accountants. So we'll be looking at courses like financial reporting, corporate reporting, or strategic business reporting for all type of exams, be it the ACCA exams or the ICANN exams or other related tertiary education exams like the masters, the postgraduate or the undergraduate issues, all those exams, we'll be looking into them. Now I would like you to watch the video and drop any questions in the comment section, and I'll be here to answer your question for you. So stay tuned and watch the video to the end.
Hey guys, welcome to Learning Accounting. Today we want to look at the cash flow question. Now, cash flow for me are one of the easiest areas of the financial reporting exams or corporate reporting exams. All you need to do is to just know some specific steps, and if you can follow these steps, I'm sure you'll be home and dry. So what do? I think we should look at the question first. Okay, I have a question here, and as you can see, the question, okay, let me quickly run down the question. I have a lot of questions here. Okay, here's the question. It says we should prepare a statement of cash flow for Kenny for the year ended 31st March 2003 in accordance with IAS 7 statement of cash flow using the indirect method and the direct method. So what I chose to do in this question is I choose to actually use both method so that at least if you're asked any of this method, you have a good idea of how to go about it. But we'll start with the indirect method first. So what do we do when it comes to cash flow question? Now, in my own opinion, for cash flow question, I always prefer students start with the profit before tax because we are dealing with the indirect method. So here we have our cash flow statement. Of course, I'm not putting the complete heading the way it's supposed to be. We have the operating activities. I'm going to give some adequate space because I know I'll need it. We have investing. Now for the investing activities, I think I should still bring it down a little. Investing activities. So I'm just going to wipe off this here. Then I'm going to create a little bit of space again. We have the financing activities. Then finally we have this section here that I call the cash and cash equivalents. So we have the net cash flow, we have the cash and cash equivalent brought forward, and cash and cash equivalent carried down. Okay, so we have just basically format, but like I always say, we will start from the profit before tax or loss before tax depending on the information in the question, and in this case we have the profit before tax. So again, I'm abbreviating this figure, all the information, 3,000. Okay, so we have the 3,000 profit before tax. Then we have lease interest and loan note interest. Now, lease interest is a non-cash transaction, so we add back. Loan note interest, we need to determine what it is. If it is non-cash, we also would add back. So for now, these two information will be added back. So we have adjust for non-cash item, and we have lease interest. Like I said, lease interest is a non-cash item, so we're adding back, which is 150. and we have loan interest. And loan interest, we have it 400. We are also adding back. Now we will always assume that admin expenses distribution cost has actually been paid for, except otherwise indicated in the additional information or the financial position. Okay, so we can leave that information. Now, what is the next thing I usually recommend students to do again? The next thing I recommend you do is to go to the current assets section because of the changes in working capital information. So we're going to leave some couple of space down here, and we have changes in working capital. And the first thing we have usually will be our inventory. Now I usually tell students to just say balance brought forward minus the carried down. Remember, the balance brought forward is the previous year figure and the carried down the current year figure. So we have 38 and 33. There is a decline. So we have 38 and 33. Because this implies that you might have sold inventory, therefore you have inflows of cash. And the difference here, by using your calculator, you get the difference of 500. So we have 500 as a positive figure. Okay, after that, the next information we have there, so we are done with inventory, we have trade receivables. Now receivables, we have 22, but this time around it has increased to 2950, sorry. So we have trade receivables, 2,200, but this time it has increased to 2,950. Again, there's a difference here of 750, and this is showing as a negative figure this time around. Why? Because we have more of our money hanging outside, therefore there's cash outflow. Now after that, what is the next thing? We have bank. Now bank brought forward we have 13, and CD we have 1980. 1003 and 1980, those are our cash and cash equivalent information. We have 13 and we have 1980. Of course, we have to check if there's overdraft in this question. So that will take us to the current liability section. Now the current liability section, we don't have a bank overdraft there. If we had bank overdraft, then we would have deducted it. We would have deducted the bank holding. So this will remain 13. And this remain 1980. So what's our net cash flow? From this, our net cash flow is 680, which is more like the final figure we are looking for in this question. We've gotten that information, but since we are still in the current liability section, then we have to round up the information in our changes in working capital section. So we have trade payables. Now for the trade payable, what do we have there? We have 2001, it is increasing to 2650. So we have 21, it has increased to 2650. Okay, so we are owing suppliers funds. That means we still retain liquidity or still retain cash. Therefore, the difference we have is 550. In this case, it will be a positive 550. So, if we come back to the question, we will see carefully that we have been able to pick up some information here in the profit order section. We left there and we went to the current assets section where we also picked up some information, and we finally picked up some information in the current liability section. Now this we've done has made our work easy for us because we are able to at least pick up some relevant information as regarding to the question. Now the next thing we can do is to go to the additional information and then finalize the question. Now what I usually tell my students is that for cash flow questions, you should be able to deal with every item in the financial position. And once you've been able to do that, then your cash flow will balance. Other than that, you'll have challenges with your cash flow statements. Okay, let's take the additional information one after the other. So the first one says on the 1st of July 2002, I believe that's the beginning of the current year, or that's during the year, Kenny acquired additional plants under a lease with an initial value of 1.5 million. Of course, this doesn't give rise to investing activities, but it will give rise to a financing activity item, and we'll get there. The right of use assets is included within the property, plant, and equipment. On this date, it also revalued its property upward by 2 million, informing us again, and transferred 650,000 of the resulting revaluation surplus. This was credited to deferred what? Taxes. Okay, so we use that information there. There were no disposal of non-current assets during the year. So yeah, the question has informed us no disposal, but there's possibility that there might be acquisition. So what do I recommend? Okay, I'll go old school. I'll do a T account for that. So we have a T account here for PPE. Now, because it's an asset, the balance brought forward will be on the debit side, while the balance CD will be on the credit side. Okay, so let's pick up the information we have there in the financial position. We have 10,007 and 14,000, 10,700 and 14,000. There's a right of use asset of 1.5. Also revaluation gain of 2,000. Okay. Other than that, what else do we have? I think that's all we got in that first paragraph. The next paragraph said depreciation of property, plant, and equipment was 900, and amortization of deferred development expenditure was 200 for the year ended. In that light, this takes us to our operating activities. We have depreciation, 900, we are adding back because it's non-cash. We have amortization, we have 200, we are also adding back because it's non-cash. Okay, but notwithstanding, I need this information here. Depreciation, we have 900. Okay, let's see if there's any other thing that would probably affect PPE in the additional information. Then we'll move forward. Okay, I think the next note does not affect it, neither does this affect it. So it means you can sum this up. You have 14,900 and 14,900. Of course, we have a balancing figure here. So let's do the summation. 14,900 minus 10,700 minus 1.5 minus 2,000, and that gives us 700. Yeah, the 700 indicate they must have purchased additional PPE in the period, which affect where investing activities. So purchase of PPE, we have it to be 700 as a negative figure because money is going out. Okay, so after that, what's the next thing? The next thing is to open the development expenditure account. And development expenditure account. Again, it's an asset account. BF starts from the debit side. CB starts from the credit side. So what do we have in the statement? Let's go back. We have new as the opening and 1,000 as the closing. So we have new and we have 1,000. There was amortization during the year of 200. This gives us a balance of 1, 2 and 1, 2. But the difference we have here is, we can say, development expenditure acquired during the year or incurred, which is also 1, 2 as the balancing figure. And that again affects our investing activities. Purchase of development expenditure, we have 1002, negative because there's cash flow going out. Okay, so if we come back to this side, you can see we are done with the PPE and the deferred development expenditure. Therefore, it means we are done with all the asset information, so we can move down to the equity section. Now, if we look at here, there were no movements with respect to equity share capital. Therefore, you don't need to bring it to the cash flow statement. Revaluation does not give rise to cash flow transaction, so you don't need to bring it there. Retained earnings could give rise to cash flow issues in respect to dividend paid, so we have to open the T account for that. Okay, so let's open the T account for retained earnings. RE. Now this one, the balance figure is starting on the credit side and the closing is ending on the debit side. Okay, so what do we have as the figures? We have it to be 1750 and 32. $1,750 and 3002. The profit after tax for the year, let's check it out. Profit after tax for the year, and the question, which is profit for the year, 2000. That will be 2000 here, and this is 3750. 3750. Now the difference here is 550. Again, the balancing figure, which represents dividend paid. And dividend paid affects financing activities. So we have it here, dividend paid. 550, cash flow is going out. Okay, so we're done with the equity section. Now we are going to the non-current liability section.